All right, let's get right into it. Welcome everyone who is present at this live stream, and welcome if you're watching later. Today we're going to talk about an update, quite a big update. This is really the first time we are diverting from the time-based statistics.
Let's get right into it.
Whoops. I was hearing myself there. What's up, Scalping Filipino? What's up, my man? How are you doing, brother? Good to see you, man, and thank you for all the songs, and thank you for pointing me towards that AI. I'm having a lot of fun with it, but I really ought to get into the nitty-gritty of things here for the people that are watching later, before I divert into sidetracks, which I really like to talk about. But now first let's cover the update. So as I was saying, this is the first time we're diverting from time-based statistics to other types of statistics. This is something I've always envisioned. I've always said that I do think completely statistically driven trading strategy is possible, but that we would need more statistics than just time statistics. Time statistics are really good. They're really insightful, but I do think we need more. And this is the first step we are taking. With that said, I want to emphasize that you have to see this update more as a beta version. And I decided to push that to everyone because, as you know, I'm not really focusing on marketing. And I think we have a good group for it right now. So I just decided to push it. So it is more beta. It's only on the daily for now. I will add the others later, but it's a lot of work to keep changing things. If changes need to be made on one, I need to make changes to all the time frames, just because of the way Power BI works. So I decided to push the daily data first, and we're gonna discuss that and see how it works. Again, this is a feature in its infancy, in its kid's shoes, as you may, but I think it's already going to be very valuable. So all I want to do today is walk you through how it works, because it is a little bit more, a little bit more statistical. But you can see here that on the daily time frame, we have here now, instead of P1, P2, we have time and distance. I deleted the direction. As you know, or as you have noticed, we've been using those less and less. I haven't really used them at all because I think they're less actionable. A natural consequence of a product evolving over time, I would say. So now you have time and distance instead. And distance, this one you're only going to see in the daily for now because I didn't change the other ones yet. But if you click there, you will get to this page and you will see quite a lot of data coming at you. This is actually the first time I'm seeing this data with, or this dashboard with all this data. First thing I notice is that there's less bars. I don't like that actually, and that is because there are quite some outliers when you go far back. So I'm going to fix that later on. But for now, I just want to talk about what we are looking at here. I want you to, for now, completely forget about this part on the right. This part on the right, forget about it. I know it looks complicated. Let's focus only on this part on the left. This is the only thing I want to focus on for now. And the way you use this, you have to see, so here we can see the percentage distances from daily open to the first pivot. So this means simply, when I'm talking about the first pivot, this is showing the historical occurrences of what the distance is between the daily open. So here's the daily open to P1, right? So this is 1.11%. 1.11%. And we can see here that 1.11% would be somewhere here in this bar. So here we could see that somewhere around 1.11% that happened 40 times in the last 2 years or so for these days. I don't have all the days selected, but that's how it is. So you can see the distribution of what the distance is between daily open and the first pivot. And we can see that it's most likely to be around the daily open, and then as time goes on, it becomes less likely, or as the further the distance is from daily open, the less P1s are put in. And this makes sense because the way I see it is price is energy in motion, right? Price is energy. So if you think about that, a daily open, well, price doesn't restart because it's coming from somewhere. But let's hypothetically say the price is at zero, at a 0 point, which it is because that's how we're measuring it. Then it will need energy to go to a certain point. And the further you go from the 0 point, the more energy is required to do that, right? So it makes sense that it hovers around that 0 point. But this actually gives us something that we can work with, because we can see this is more of a normal distribution shape. I want to get into a normal distribution shape more later on. I'm going to make probably a separate video on it because I do think it's important. It's probably something that a lot of people have maybe forgotten in after hearing about it in high school or college or university or whatever. But I think it's going to be pretty important for us. It's a holy grail of statistics, so to say. But we can really work with it, because what we see is basically what you see here is that the most of the P1s are close to 0, right? So most of the P1s that are put in are close to the daily open in terms of distance. So they're close. They're somewhere, let's say somewhere in, if you have the daily open here, oh, that's wrong. If you have the daily open here, then somewhere here to here. So really close, which is nice, right? Because we already know that, okay, the closer it is, the more likely it becomes. And that is actionable in a way that we're going to see. This is going to be, for me, I've been testing this out, and it's been pretty good so far. So what we see here, other than that, I'm going to forget about this filter for now. I do want to focus on this chart because I think it's the easiest. But what we can do, or let me explain it like this. What I use this chart for, and of course, maybe you have a way of another way of using this chart. But what I use it for is that I want to see how likely is a P2 going to become a P1. So for example, when we are at the time page, right, and we have a P1 and a P2, so say we have this is P1 and this is P2, or a better example would be this, both of them are not very high probability, but you have to look at both of these to know. So if I have our 4P1, our 7P1, then at this point it's more or less the same probability, right? So we can say, well, there's 3% this is P1, will stay P1, and there's a 3.9% chance that this will become P1. So what I do personally with this one is that I will look, okay, how likely is the current P2 still going to become P1 in terms of distance? And I'm going to show you with a practical example. So say we have the time of today, right? Let's say we come to the charts at 11 a.m. I think that's safe. What I can see now, so here I'll probably put this in an indicator at some point so that we don't have to measure that manually, but there's only so much I can do at a time. But this was the daily open, right? Candles daily opened here. So what I can see now is that this is negative 1.67% away from daily open. So the P2 is negative 1.67% away from daily open. So what I can do is I can go here and I can say, well, this is negative 1.67%. So this is the percent distance from daily open to P2. So exactly what we're doing here. And then I'll let it go. And then what it does is that it calculates here. So here you see the percentage of first pivots more than negative 1.67% away from daily open. So those are these in red. The occurrences in red is what could still, or are the occurrences where there was more distance than negative 1.67% from daily open to P1. And the reason why that matters is that now you can pretty much say, well, that means in terms of distance, there is a 27.5% chance that this is going to happen. If you have any questions while I'm explaining this, let me know. What's up, Auke? How are you doing? You didn't miss anything, man. Because I realized if there's any confusion, please ask. Because if you have a question, other people will have the question as well. and it will be good to answer it. But for now, so what this means is that I can see that if we were to take this out in terms of distance, that would put this P1 in the bottom 27.5% of occurrences, right? So it's already, this is already an edge. This is already an edge. I'm gonna say it because statistically speaking, you have only 70%. I do have some more things to say about this, but we're gonna get there. So now we already know. So let's take this hypothetical example, and this actually played out today, where I was saying, well, I think P1 looks strong, because of this this pattern that I've discussed in the voice chat a couple of times already. But I'm not going to discuss that now. But B, so say we have now 5 and 10. This is a really good example actually, because this is exactly what I was talking about. We have 5, we have 10. So right now, this is very low probability to hold, and this is very low probability to be P1. See? Exactly, this is actually a really nice example. So right now I'm looking at this, and I see, well, there's a 3% chance that our 5 will be P1, and there's a 3.3% chance that our 10 will be P1. So in terms of which one is going to be P1, it is really even Stevens, as we would say it, right? We have no clue. But enter distance, enter distance. And this chart is the most important chart of this whole screen, this one. This one. So what I can say now is, well, but this one has 27.5% chance of being P1. All right. What I could also do is put this one in, and this one is 1.1% from P1, 1.1. And we can see this one is slightly higher, probably. Also, not that high, but I think, so this is something I want to explain later about volatility. No, it actually looks quite decent. So about 60%, and the other one was more or less 73%, right? So this one lies more in the probability range, but personally, I'm not using to see how far or how close P1 is. I personally don't use this. There's a reason I put this as distance d open to P2, because in my opinion, the way I see it, this is already P1, right? So we don't need to see how likely this is to be P1. I mean, of course, there's a reason to do that, but it's already P1. The thing I want to know is this going to be P1? Or how likely is it in terms of distance that it's going to be P1? So then again, if we have negative 1.67, then we can see, it's less than 30%, so very low. So where I had, in terms of time, an even probability, now I can say, well, this one, in my opinion, is very unlikely to be P1 because it is just too far from the daily open right now, and I can see from statistics it's not very likely to do it. 28% of the time it will happen, given the same volatility on average will happen. But then I can say, more than 70% of the time I'm going to be right. So 7 out of 10 of the times I'm going to be right that this is indeed not going to be P1. And therefore, I would much rather say, well, this is going to be P1. And I actually mentioned this in the Discord today. And have some extra confidence. And what can happen then is that I don't have to look at this P1 percentage here, right? I can say, now I'm going to scratch this. The only thing I'm going to look at is, well, for now, this will hold. Maybe it will get taken out later, but it will hold. All I will see is here, this one. Well, this doesn't make sense right now because we're too late and I don't want to go to time offset. But I can see there's a 1.8% chance of this being P2. And it was actually P2 yesterday, funnily enough. Not showing up. I will check out why it is. Maybe it's not very last datum. I will check out what it is. But anyway, I think you see already the point I'm trying. Oh wait, never mind. It was P1. But I think you already see the point I'm trying to make, is that it will give you extra confidence to see, okay, how likely is that P2 going to be P1? Because the further it gets, the less likely it is, right? So let's go on. So here, our 11, we go even lower. So now we can measure again. And again, I'm going to alternate this. I'm going to put this in the indicator. Negative 1.99. Let's see. We can see that now it's only 20% of the time this puts in a P1. So you can just see it becomes less and less likely to become a P1 the lower it goes, which makes sense, obviously, intuitively. If you think about that, you're like, well, that makes a lot of sense. But now we have actual data and actual statistics and actual, well, we turn it into actual probabilities to see how likely it actually is. And it will give us a way better understanding. I actually think this is going to be even more powerful on, for example, the 4-hour. But as I said, it's only available on the daily. I just want to see how people get along with this and make some changes according to it. So one more note I want to say, you see you have here red, blue, and gray bars. And the reason for that is that the red ones are what the observations that are less than 1.99% or negative 1.99% or less. So it just highlights how much of those it is. And the reason this is important, or well, let me put it like this, is that the blue ones are the ones that are above it, right? So the blue ones are above. This can no longer be it. If P2 would become P1, it's going to be either of these observations, right? It's not going to become less distant from daily open. It cannot do that. It's just already there. But so this is the observations that are the current distance or lower, and these are what is higher until 0. Then you also have gray bars, and the reason for that is that actually effectively we are splitting this normal distribution based on where it is, based on where P2 is. So if P2 is negative, in this case, I don't care about these plus observations, these observations that are higher. The reason for that is that I've noticed that they behave a little bit differently. There's generally a higher chance. So let me put this like this. If I now negative 1.99, we see a chance of 19.4% of a P. This is basically saying what the chance of P1, P2 flip is. That's how you have to see it. And well, now it's actually kind of the same. I guess it was because I had limited data, which makes sense. So actually that means I could possibly change that in the future, but for now what's important to understand is that for this calculation, it's not taking into consideration these gray bars. That's why they're grayed out. It's just looking at the observations that are lower. But now I see this, we could actually apply normal distribution logic, which would be interesting. But again, I'll get to that later. The only thing important to understand is if P2 is below the daily open, and it's going to only look at the negative values. And so what it's doing, it's calculating the percentage of observations that are below this or equal to or below this. And it's taking that as a portion of all the observations in either blue or red, right? So this is saying 19.4% of observations below zero are negative 1.99% or less. So I hope that makes sense. If not, let me know. And if it does, I'm just gonna continue. Here you have P1 hour. So this is actually an important time to maybe discuss this one. This one is probably gonna be deleted at some point, but for now, this is showing is the average distance between daily open and P1 by P1 hour. So this is showing the P1 hour, all right? So these are just the hours 0 to 23. So when a P1 was put in, and this is showing the average distance from daily open to P1. And what we can see is that it's slightly increasing. What this means is that the later a P1 is put in, the more likely it is to be further away from daily open. This intuitively makes sense. Right? Because it has more time to deviate away from daily open. Oftentimes with afternoon hours, you will go one direction until the afternoon to New York Open and then reverse. So it makes a lot of sense, but the practical application of it is that we want to filter for P1 hour. And the way I do it, for example, if we have the same situation here, hour 5 is P1 and hour 11 is P2. The way I see it is that pretty much hour 3 to 11 are low probability hours. All I would do is remove, I'm going to remove this blank one and see that I would remove probably the high probability hours or the hour 0 to 1 to 2, because you can see again, I mean, play around with it as you wish. This is how I do it right now. This is how I do it. But we can see that here, hour 0 has an average of 0.5% distance from daily open. And we can see here that hour 13 has already 2.4% average distance. So it's really quite a difference. So you want to take this into account. So if I see that P2, again, I'm trying to answer how likely is P2 going to become P1. And in this case, let's go back here. Right, and we have this same situation of, oh, I measured it from the wrong point. Right here. Of negative 1.67%. Then this is going to change. It's going to become more likely because I already know I'm going to delete the one with most observations at the middle. So you can probably see that here, bang, right? You see that I delete P1 at hour 0 and immediately this just drops. I will delete these as well. And here now you can see, okay, so now it becomes interesting. So now you can see that instead of the earlier 27%, it's now 41.8%. Still an edge, right? But it's less, how do you say it? It is less convincing. Less convincing. So this is very, well, this is at least the way I've been using it so far. There's actually some really good setups where you have like very promising, especially when you have hour 0, right? So the way it works best, I find hour 0, 1, or 2. If you have one of those as P1 and you have a good displacement, then you oftentimes will have a very good probability that hour 0 is going to hold both in terms of time and in distance, or hour 1 or hour 2. But for example, what I've also already seen a couple of times, that this happens, you know, and then you come this, and then you really have like a 20% chance of this becoming P1. So then you can be pretty sure that you can short this. But we have negative 1.67. This is how I do it. Actually, what you could also do is say, well, I'm only gonna look at these and I'm gonna delete all the afternoon ones because we know those are higher. Maybe I need to come up with a way to filter this faster. Maybe the 3-hour ones are better. So then we can see, you know, for these, it's more or less 39.1%. Right, so we're now I'm selecting only the low probability hours for P1, which am I 3 to 11. I kind of see them as the same thing, more or less. You can see these are also not that far out from each other. It's not that far. I mean, these bit, but it's probably more because there's not that many observations. Now you can explain the difference. If I delete this, yeah, then you can see that the trend line pretty much disappears. But now we have like a chance of 40% for this one to be become P1, the current P2 in terms of distance. And interestingly enough, for this selection, we can see that the distribution is different. There's actually, it's very interesting. So I'm not going to dive into this now, but I'm definitely looking forward to exploring these kind of patterns. Is that I can see now that for some reason, if P1 is in one of these hours, and it is above 0, it is way more likely to be close to 0 than it is when it's below 0. So in other words, so these are the kind of patterns we'll be able to discover. Like this at hour 5, somewhere here, would be way more common than this at hour 5. Very interesting. But that's how I used the filter so far. And then, for example, if I would have hour 0, you can also just look at those. And you can see, right? If you have hour 0, P1, how close that usually is. All right. I hope I explained that properly. And that covers it for this chart. Obviously, again, I'm not using it as such, but feel free to use it like that. If I select this one more time, I can see here it's 1.1. So this one is about at the 50% mark, which is quite good. But then again, we can keep doing this, and right, the further we go, the less likely it is to become a P1, -2, -2, even less, 27.6. And then what you can also do, for example, is that, yeah, we had, oh, wow. So we have a lot of New York Open reversals, but this one was -4.93. So I can look then at just the New York Open hours, more or less, the afternoon hours. And even at the afternoon hours, which are more likely to be further away from 0, we can see that this is a 3.1% chance of becoming P1. So at least we know that for the rest of the day, this like P1 flip is not going to happen anymore now, right? Or at least a very low probability, 3%. So it's also very interesting to see because this teaches us that if you want to see a, let's see like this, P1, P2 flip after New York Open, then you can just look here and see how far it usually goes, right? And you can see it doesn't go that far. This is like -1.38, -1.78, -2 at most, and after that, really low probability, right? You can see that if you put -2, you can see there's only 30% of the time it goes that far. So for P1, P2 flip after New York puts in a high or a low, a P2, that you really don't want to go that far, right? And you can just see how you can kind of mine through the data and find out different strategies based on this. All right, with that explained, this one is very simple. This just shows the moving average of the total distance between P1 and P2. And this is a chart I have here. We're going to go into that, but this is basically a volatility indicator. So it just shows how volatile the market is. The higher this goes, the more volatility we have, right? The more average distance we have from P1 to P2. This is literally just measuring the distance from P1 to P2. So this, right? -5.95%. That is, Yeah, mostly I put it in there because I think it's important to see how volatile we are right now. Because you can, for example, say if you see you're in a very volatile environment and now we're a little bit more volatile, then you can anticipate, well, well, we might go a little bit further away from daily open than we would normally do. And I checked, and the reason I don't actually have the daily open distance from P1 is because they are very correlated. So this is pretty much the same. If this goes down, then the distance from daily open to P1 goes down pretty much in the same way, right? So if the distance between P1 and P2 increases on average, then also the distance between daily one and daily open and P1 increases. And we really gotta start working on a Minoma vocabulary. The jargon is increasing and increasing. But so that's why I have on there, right? If you and you can here select right now, selecting the last 30 days. You could also, for example, say, well, I want to look at how volatile we are for the last 50 days. And then obviously it's going to be a bit more lagging. You could also, for example, do the last 10 days, and then it's going to be more responsive to recent changes, right? So more or less around 5%. This dotted line is the average, or the dashed line. All right, then we're moving on to the next stage, and that is this. So this shows distribution of the distances from the first pivot to the second pivot. Now this is more or less an experimental feature. I like this one. I definitely like this one. This is the main, this is the core, right? This is the core of this page, this chart, and we've covered the most important. But I was thinking, well, while I'm at it, why not add some more data? Because why not? And this one is showing the same here for the distributions, only then for the distance from the first pivot to the second pivot. So again, it is simply showing the distance from this to this. But then for the end of the day, which was lower than here, but you get what I mean. So the reason I did it is, for example, I could say now, well, now daily open P2 is negative. Oh, we already way past that. It's negative 4.93%. Well, let me actually put this one back. So here we had negative 2.77%. Gonna delete these. Get at least a little bit of an accurate depiction. We can see, so this one is 17.9% chance to become P1, so probably that's not going to happen. And then what I figured, well, it would also be nice if we can more or less get a probabilistic range of how likely we are to go further down. So here, for example, we had negative 3.81%. So we can put that in here. This is the distance from P1 to P2, right? Negative 3.81%. And we can see that in 52% of the cases, it goes down further. Now, I do want to make some remarks on this. Again, we will have to see how this is going to play out. But I think it's going to be very important to also kind of stick with this volatility. Now, in this case, I think it's more or less the same, but preferably maybe you would want to have a date selection where everything is more or less the same volatility. And this might be a feature I'm going to implement in the future, where instead of just picking a fixed date range, you can select a certain volatility measure. I don't know yet. I've been thinking about this. But obviously, if you take this, for example, say you were here and you were taking the data from here when you were highly volatile, then it's not going to give you good measurements, right? Because if you would take the data from here to forecast here, then probably, if you would have a very low volatility environment, then it would say that it's very likely to go higher or lower, but you're in a very low volatility environment. So it's probably going to be a false reading. So you kind of want to have more or less the same volatility area. So in that sense, for example, this is already quite low, right? This was where we had quite low volatility. So preferably I would not even have this data, But in the end, at the end of it, if you just have a good average, that's good enough. I do think that it is good enough, but it is definitely something I want to take into account. So, for example, I think a little bit. Oh, so I don't want to have this part because I see that we were just very volatile. This I would like, and then I can see, well, there's a 43.1% chance that we will go lower, and I have to check actually. Let me check something. Yeah. All right. So I was just checking if that's okay. So this is saying that in 54% of the occurrences, we go lower than 3.8% on the day, right? Lower than this. So there is a little bit more than a 50% chance, just purely speaking from that. I've noticed that this is not. Oh yeah, now I see the same thing happening here though. This is the reason why I am counting below zero different from above zero. Look, for example, what happens if I put 3.79. This is 54% and this is 64%, right? So what you can see here is that for some reason, well, not for some reason, you are more likely to go up more in percentages than you are going to go down more in percentages. And the reason for that is probably because, if you go down, you just go down less. If you go down $1,000, I think you go down less in percentages than if you go up $1,000 because of the way it is calculated. So that's probably why, and that's why I make a distinction in it, right? But so this one is to answer the question, how likely are we going to go further, right? How likely are we going to displace further? So the way I see this, kind of like a two-pack punch, is that this one is to answer, okay, how likely is P2 going to flip P1? In this case, we had answered, well, not likely. So we can say, okay, P1 is P1 for the day. Very unlikely that it's going to be flipped. And now we have that, we can answer our question of like, okay, how likely are we going to go down further? Right? And if you have like bearish TA, high probability P1, and you see this, then that might not be a bad thing that you can say, well, that looks pretty bearish to me. And here, P1 hour, I pulled these apart. They're basically the same thing, but they filter the different ones because, well, you will see that's just, it's more convenient that way. Oh, I see already something I need to change. Well, there's going to be some bugs in there. I want to have that one. There you go. So what you can do with this is say, for example, now the P1 hour is 5, so it's definitely not one of these. And then I can see, well, how far do we usually displace based on when P1 is in such an hour, right? And I haven't really played around. From what I've seen, this doesn't matter as much as that this has an effect. So this one has quite an effect on these numbers. This one, not as much. But maybe there is. I mean, play around with it, find out, right? All right, and then finally, I'm just jumping in the chat. I really wish I had questions to prove my interest. But it's just really clear and whack. Whack. I don't know what that means, but I'll take it. It must be clear. Oh, well explained. All right, cool. All right, and then finally, here we can see just the last days. In this case, I don't have Sunday and Saturday selected, so you don't see those. But we just have a list of the days of what the P1 hour was, what distance was of daily open and P1, and what the total daily displacement was. Now, the daily open magnetic P1 is red because this is showing, it's basically coloring red for the same reason, right? It is showing what is less than 2.77%. Less than 2.77%. So if this is red, then you can see here, well, yesterday, Tuesday, this actually happened, right? So now we're saying, well, there's only 10.9% chance it happens. And we can see here, well, it happened actually yesterday. And these are not colored at all because they are plus, right? They are when the daily open or P1 was the top. In this case, P1 was the bottom. So these ones I don't want to consider for that. But here we can see that these are all below our current threshold, right? So we have negative 2.77. So we can see, yeah, and so we scroll down, we can see indeed visually that it's way more likely not to happen, right? We can just see, if I look at this, all green numbers, except for this one. So you can just see it really doesn't happen a lot. Now you could say, for example, well, I want to see when it's lower. So say, well, yesterday was lower. And let me actually give you a cool one. You can hold shift. You can hold shift and you can select these bars here. And then we'll select only those bars. And what it will do, it will select only those here. So now I have a list of days where P1 was more than 2.77, negative 2.77% from the daily open. What I could do, what I'm going to do with it is that I'm going to look at these and I'm just going to go to the charts. I'm not going to do it now because it's too time intensive. But well, let me just do one. So I can say, for example, oh, well, on Tuesday, April 16th, it happened. And then I go here and well, here it is, right? And I can just see, well, you know, why am I doing this manually? I have an indicator. So P1 was this one. And I will see, well, okay, so in this case, we went down indeed like that 2.97%. And then we went up. And what I can do then is I can go to the next one and I can look what happened there in terms of price action. Again, I'm not going to do it now, it's too time intensive. I don't want to keep this too long. We'll discuss all of this in streams, I'm sure. But I can go to the next one and I can see, okay, well, what happened there? Or I can look at, well, which hours were they, right? So here I see, well, I mean, not necessarily pattern yet, but what I often do is then I go in the charts and I look if there's any specific price action pattern that I can recognize visually for that. So actually this is a really cool one, and you can, you know, select one of them even. I can say, for example, I can say, well, I want to know which one was this low, negative 0.5%, and then you can see it where these two. And then I could, for example, go there and see what happened. But we can see these ones were in the bear market, right? So they're not very likely to happen now. Which is also a good one to take into account. Again, I'm also learning here, right? This is more or less a beta version. Because this was very high volatility, but this was bearish volatility because we were in a bear market going down. So obviously that's also going to be different. For example, maybe it would not be a bad idea to take the previous bull market as data. So, for example, you could go here and take March 20 to April 21. You could do that, right? Because you're like, well, we're in a bull market now. In my opinion, it makes a lot of sense. March 20 to April 21. 12th of April. And again, I'm just thinking out loud here. But definitely no need. I'm just giving you the things of how I do it. But I'm just trying to show you there's multiple ways of doing it, right? We're getting more data, so there's more data to play with. Wait, this I'm not doing well. What am I doing well? April 21. It was March 20, not March 21. So for example, I can say, well, you know, maybe this data makes more sense because we're in a bull market right now. And you can see, for example, that we had way less P1s at the top, which makes sense in a bull market, right? Because you have way more upwards price action. And actually, funnily enough, you also have here this average is more or less the same, I think. So just showing you there's multiple ways of doing this. So this that you have more observations below the zero line simply means that you had more bullish days. Likely. Funny thing is though that this is really high, but you have also more positive days. But okay, that's just drifting off a little bit about applications already. I'm gonna change this one as well. Yeah, and then finally this I have this column where we can see the daily displacement. So that is this one. And here we can just see how far it was. So for example, here we can see we have negative 3.79%. And here we can just see whatever is red was lower than that. So we can see that Monday, April 15th, we had actually less than what we had here. And again, I can select all these the same way. And then I just see that, wow, actually all of them are below this. Damn. What? Oh, of course, sorry, because I'm an idiot. I've only selected the ones that are below it. So if I do this, then you can see a lot of them are red. Man, I have to check the data if this is indeed 53.1%. I actually cannot imagine. Maybe it's calculated wrong. I'm going to double check that after the stream because I see a lot of red. This is also why I have it, right? Also, but here's a lot of green, so it could be. Still see more red, I have the idea. But there you can see how you can work with that, right? So it's more that you can see. And oh yeah, by the way, this table also, this P1 hour table filter does not filter this table, but this one does. Because I only need one. So if I have here hour 0, you can see I see only the hour zeros. And the reason, in case you're wondering, why the background is different, like so here you have one row with this as a color background, and then this one is basically because when the daily open P1 is below daily open, so in case we have here, then usually you have a positive, right? Usually that leads to well, actually always that leads to a positive displacement for the day because you measure P1 to P2. So in this case, it would mean that we have negative 2.77, and then probably the total distance from daily open will be higher than that. But the reason why this is, I don't know how to call it in English, to be honest, but it's because we're not looking here, okay, what is P1, right? We're looking at what is the distance from daily open to P2. If I, for example, would do this, then it's going to make sense. So here we have they open 1.14%. And the distance P1, P2. But now you can see, you know, now we would actually have P1 here, right? P1 is above 0. And now you can see it is, call it the same way. Because now we're looking at one row. Now we're looking at, okay, what is, if P1 is above it, then how far do we really go? And here you could just see that, well, if I just take this one, we're quite likely to go lower, right? If you look lately, this is also a good one, right? Also just to look at it, even if this is really 53%, I'm really gonna check it. I can just look at, well, what did we do lately? And look at that. I see mostly we go way lower if we have a negative day, except for here. So here, for example, I see in November and December, we had a while where we didn't do that. And then I could, for example, check, okay, what was happening in November and December. Yeah, and then I see we were on a massive uptrend. And then I can say, well, is that the same as what we're doing now? And I can say, hell no, we're consolidating sidewards or / bearish. So it's not the same thing. It's not the same thing. So in this case, I would say, well, I'll discard those. I'll just look at these. We're way more likely to go down, right? So it's actually really nice to use it like that. Again, I'm probably going to change things in the future. I really want curious on the feedback. But in the end, let's see what happened. And then I'm gonna close the stream off. We actually dumped down further on this beautiful volatile day. And we came down to, god damn it. All right, this is annoying. I'm really gonna create that in the indicator. Jesus. What the hell? Why is this thing not working? There you go. Negative 6.6%. We can do that. We can see here that the red numbers will change. We will probably have a lot more green. There you go. Because it's taking this as a threshold, right? And we can see there's only 80% that went lower, and we can see here that indeed it's already a lot less likely to go lower. So at this point, you will not be betting the farm on that it's going to go lower, right? And you could, for example, combine it with time statistics, I guess. So for example, if you see our 16 is high probability time, a high probability time to put in P2, and your low probability to go lower in terms of distance. So, you know, would you bet your horses on going lower? Probably not. And this is really nice to see, right? So this, I personally really like this. I said I did it mostly for myself as well. But here I can, for example, see if I want to do some research, okay, on these days we actually went lower. So I want to see, are those comparable to where we are right now? And I can imagine, for example, that these would be at the top of a range or something. And now we're at the bottom of a range. And with that, I think that's all I have to say about this new feature. Oh, I do see I need to change this. Yeah, so there's going to be some bugs and stuff because I just released it. I will definitely fix it as soon as I can. But I have now covered, I think, everything there is to say about this this feature here. So let me jump in the chat. Is it possible to combine the pivot data and the new data into a single graph that could give an instantly visual representation of how likely pivots are going to happen? Yes, that's a very good suggestion, and that is my next step actually. So my ideal goal is that next up, when I have all of this properly implemented, right, this is probably going to take a couple of weeks, if not longer, to properly implement, to get a feedback from you guys, to see, we'll probably learn things, what is good data, what is bad data. Anyway, when all of that is implemented on all the time frames, what I want to do is I would very much like to automate the whole process. So for example, now we have to type this in manually. I don't know if it's technically possible yet, so don't. I'm not making any promises. Don't hold me to this. Taking a sip of water. What I would like to do is that I could live stream data, and that we don't have to manually enter this anymore. I mean, you could if you want to, but where you could that this would automatically pull data, and it would just know. So, for example, now it would just, you don't have to enter it. It automatically knows which P1. What the distance is and what the time is, right? And what I would want to do then is create a summary page for all assets, where you can just see a summary page for all assets with the percentages of both the probabilities of the P1 holding and the P2 holding in based on time, and also the probabilities of P1, P2 flip happening in terms of distance, and the probability of going further, and maybe even into a single metric, right, that you combine them. So then in the end, what you have to imagine is that what I want to have is that single overview where you can just have a table with all those probabilities for all assets on the day automatically generated. And you can, for example, see, hey, Bitcoin US dollar has 60% chance to hold P1 in terms of time, 20% chance to flip it in terms of distance. So really good probabilities that we're going to go into the opposite direction of P1, right? So trade with the trend. And then you can see, for example, that Arweave, your favorite, will have a 10% chance of holding P1 and a 70% chance of flipping it. So then you, for example, would target P1, right? So stuff like this would be really, really cool. The intermediary step to get there, I guess, is change this summary page. I was going to change it where you would see what you're suggesting is basically for a single coin, just have an overview of that. So I would say that's a very good intermediary step before getting to the ultimate solution, which will obviously require a lot more technical capabilities, but we'll figure it out somehow. So that's a very long answer for yes. Yes, we're gonna do it. Where the factor on the graph are percentage on the y-axis and time on the x-axis. Oh, wait, but where the factor on the graph are percentage on the y-axis and time on the x-axis is, you mean the y-axis, you mean the probability of, you mean the probability of the displacement, right? Yeah. Yeah, that's actually a really good idea. Yeah, really good idea. What's up? X Omni Science in the house. I missed it all. Please start over. Then I don't need to watch it all back. You're coming in right at the end. There was an addition on my question. Correct. All right. Well, awesome, man. Yeah, that's a really good idea. Actually, I'll probably do that when I create that summary page. It's a really good idea. It's a really good way of visualizing it. So thank you for that input. That's actually really smart. I'll definitely do that. All right, but yeah, I wanted to keep this as short as possible, but as soon as I started it, I realized it's actually quite some explaining to do. But everything is explained now. In summer in the future will probably make some tutorials, but with the current pace of development, it doesn't make sense to make tutorials because by the time I release the tutorials, I have to remake them because new features came along, and making tutorials is an absolute grind. It takes a ton of time, so I'm not gonna do it right now. But I do live stream more often, so I think everything will be clear. And I think this was a pretty extensive explanation so far. So I want to thank you, Auke, for the good questions, the ones that came in at the end. And if there are no further questions, I want to keep it at this because, like I said, I want to keep it as short as possible for people watching this later. So yeah, they don't have to drag on endlessly into understanding how this works. So I hope you are excited about this feature. If you're watching this now or watching it later, I personally am. I have tested it out for the last couple of weeks, and from what I've seen, it's actually well, we simply have more data to work with, where we now have time and place, which gives us way more opportunities because we can now combine data. So we can now, I think we are now very much getting closer of having purely statistically based strategies. I honestly think we can get to a point where where we barely have to look at charts anymore, right? But that's a little bit further into the future, but I think it's possible. After this, I'm going to work on session statistics, which is heavily demanded by OmniScience, and rightfully so. So we're going to see how often, for example, the New York session sweeps the Asia session. But for now, obviously, we're going to onboard this same statistics on the other time frames. I'm actually really excited to see the weekly. I don't know why. I just really want to see these statistics for the weekly. So I'll be implementing those and all the other ones. Then optimization and all those goodies, man. We're going to have a good time. We're going to keep developing, make this thing into a really cool dashboard, and we're going to own the markets. So let's do it like that. final message. You're welcome. Thank you for this awesome explanation this unholy time. Yeah, man. I'm definitely gonna switch off and take a chill for the rest of the evening. So I want to thank you for your very attentive participation at this unholy hour, my friend. All right, guys. I need to eat something more after the run. I'm gonna thank you and leave you, and I'm gonna catch you in the Discord. Have fun using the dashboard. Give me the feedback, or this new feature. Give me some feedback if you have it, and let's catch up soon, man. All right. Have a good one, and talk to you later.